Welcome to the Deep Dive. Today we're jumping straight into Marvell Technology's first quarter fiscal 2026 earnings call.
That's right. We've gone through the whole transcript management's remarks, the analyst Q&A, everything.
And our goal is simple. Boil it all down for you. We'll hit the key results, what management's saying about the market, especially AI and their outlook. Basically, get you the crucial insights fast.
Yep, cutting through the noise. Marvell kicked off their fiscal 26, and, well, the numbers definitely have a story to tell.
Okay, let's start right there. The headline numbers for Q1 fiscal 26 revenue
came in at $1.895 billion.
And how did that stack up against expectations?
Pretty good, actually. It beat the midpoint of their guidance. Sequentially, it was up 4%, but the really striking number is the year-over-year growth.
Which was?
A huge 63% jump compared to Q1 last year.
Wow, okay, 63% year over year, that's serious momentum. Did that filter down to profits?
It certainly did. Non-GAAP earnings per share also landed above the guidance midpoint, and the growth there, even more dramatic. 158% year-over-year growth in non-GAAP EPS.
158%. So that's that operating leverage really kicking in, right? Earnings growing way faster than revenue.
Exactly. Costs don't scale quite as fast, so you see that amplification on the bottom line.
Okay. Strong top line, even stronger bottom line.
Yeah.
What else was happening financially? Any big moves with capital?
Yeah, two things stood out. First, they really stepped up their stock buybacks, repurchased $340 million in Q1.
Which is up from
$200 million the quarter before. So a significant increase there. Shows confidence, and a focus on returning cash.
And the second thing, a strategic deal.
That's right. They announced the sale of their automotive Ethernet business.
To Infineon, I believe.
Correct. For $2.5 billion, all cash. They expect that to close sometime this calendar year, 2025.
So that's a nice chunk of change coming in, give them flexibility.
Definitely. More options for how they allocate capital going forward.
All right, headlines covered. Let's get into the details. Where is this impressive growth actually coming from? Break down the revenue by end market for us.
Okay, the engine here, it's absolutely the data center market, no question.
How big was it in Q1?
It hit a record $1.44 billion.
Wow. And is a slice of the total pie.
A massive 76% of total revenue this quarter. Sequentially, it grew 5%, which is solid, but year over year...
76%.
76% growth year over year in data center. And management was really clear. AI is now the majority of that data center revenue.
The majority already.
Yeah, and they expect that percentage to keep growing. They even suggested AI could eventually become the majority of Marvell's entire company revenue.
Okay, so AI is clearly the dominant theme. What specific AI drivers are benefiting them most right now?
It's a mix. General demand for AI infrastructure is obviously strong, but for Marvell, it's really about their custom AI silicon programs ramping up fast. They're hitting high volume production.
Custom silicon? Okay.
And also strong shipments of their electro-optics products. The stuff needed to connect all these AI and cloud systems together.
Let's focus on that custom AI silicon for a minute. They talked quite a bit about a lead XPU program for a big US hyperscaler. What's the story there?
They sounded really pleased with it, described it as doing extremely well, a major revenue driver right now. They specifically highlighted how quickly and successfully they ramped it from the initial A-silicon right into high volume.
Which isn't easy to do.
No, not at all. Especially at these volumes, it says a lot about their execution and, frankly, how badly the customer needed it.
And this isn't just a one-shot deal with this customer, right? They're looking ahead.
Exactly. This is maybe the most important part. They're already deep into the next generation design with this same customer.
Okay.
And crucially, they've locked in the capacity they need 3-nanometer wafers and the advanced packaging for that next-gen chip. Production's expected to start calendar year 2026.
3 nanometers secured for 2026. That's significant.
It is. And get this, their architecture team is already working on the generation after that one.
So this is truly a multi-generational partnership they're building.
That's the key takeaway. It shows deep integration, deep trust. And it gives them visibility, revenue visibility, not just for this year, but into fiscal 27 and beyond. They were confident revenue from this customer's custom XPUs will keep growing for years across generations.
Even if that customer uses other suppliers too.
Yeah, they acknowledge the customer might have multiple paths, but they seemed very secure in their own position and growth trajectory with them. It feels foundational, not temporary.
That's a strong message. And they have another big hyperscaler win too, right? Announced last year.
They do. They gave an update, said development on that second major custom AI XPU program is going well. And similar story, they're already engaged on the architecture for its follow-on generation too.
So replicating that multi-generational model.
Seems like it, expanding that custom silicon footprint.
Beyond just the chips, they also talked about their broader technology platform enabling like full rack-level solutions. What were some examples?
Yeah, two big ones they mentioned were custom high-bandwidth memory, HBM, and co-packaged optics.
Okay, HBM first. What's their angle there?
They're working on optimizing the connections, the I/O interfaces. HBM is that super fast memory stacked right near the processor. Making that connection more efficient means faster access, better AI performance, quicker run times. They said customers focused on performance and total cost are really interested.
Makes sense. And co-packaged optics. Sounds complex.
It is, but it's crucial. Basically, it's about putting the optical components, the bits that turn electrical signals into light right next to the main chip, like an AI accelerator, in the same package.
Why is that so important?
It's all about scale and speed inside the system. As AI clusters get bigger, connecting everything with traditional copper wires hits limits, especially over longer distances within the rack. Optical fiber is the way forward.
So co-packaging enables that shift from copper to optical within the package.
Exactly. It allows for bigger servers, more memory, more processing power without the copper bottleneck. They see it as a huge expansion opportunity for their interconnect revenue down the line. It's really key for these massive scale-up AI clusters.
Got it. They also made some partnership announcements recently, NVIDIA, for instance.
Right. They partnered with NVIDIA to add NVLink C2C Fusion Tech to their custom platform. NVLink is NVIDIA's high-speed interconnect.
So what does adding that do for Marvell's customers?
It gives customers building their own custom AI chips an easier path to connect them within NVIDIA's broader ecosystem. It's offered as a chiplet solution. Marvell sees it as validation that custom chips can complement standard GPUs like NVIDIA's. They said they've already got customer interest.
Interesting validation point. And a new packaging platform, too.
Yes, a new multi-die packaging platform. It's actually already in production for one customer program. Uses a special kind of base layer, an interposer, to connect multiple chiplets very efficiently.
Better performance, lower power.
That's the idea. More efficient chip-to-chip links, potentially better manufacturing yields, lower cost compared to some traditional methods. They view it as a strong alternative for future multi-chip designs.
Okay, so they're really building out the whole toolkit, custom design, packaging, connectivity. Speaking of connectivity, their standard interconnect stuff like PM4 and DCI is still vital, right?
Yeah.
Especially for AI and cloud. What do they show at OFC?
Oh yeah, OFC, the big optical show, they had a lot there. A key highlight was showing the industry's first 400 gigabit per lane PAM technology.
400 gig per lane. Why is that significant?
PAM tech packs more data onto each signal path. Hitting 400 gig per lane is a critical step towards things like 3.2 terabit optical modules, which future AI networks will need.
Okay, 3.2T. What else stood out from their OFC showcase?
Well, continued progress on co-packaged optics and also co-packaged copper. Silicon photonics light engines scaling up to 6.4 terabits. 1.6 terabit linear drive pluggable modules using their silicon photonics.
Linear drive, that's for lower power, right?
Generally, yeah. And they also announced the first 3 nanometer 1.6 terabit PAM4 DSP. That's the brain of the model.
3 nanometer, wow.
Benefits. Hits 200 gig per lane on the electrical and optical side, and they're claiming over 20% power reduction, which in these huge data centers is a really big deal.
Absolutely. Power is everything.
Yeah.
Any other interconnect highlights?
Let's see. Next gen 800 gig DCI modules for long haul links up to 1,000 kilometers. Production ready 1.6 terabit AC DSPs, those are for shorter, in-rack copper links. Coherent DSPs for campus networks up to 20 kilometers, and their latest PCIe Gen 6 and 7 SerDes tech, enabling that high-speed connectivity over optics too. They said the feedback at OFC was very positive.
So strong across the board, not just custom AI, but also the fundamental plumbing needed to connect it all. Okay, let's zoom back out. Data center was 76%. How did the other pieces of the business do in Q1?
Right, so enterprise networking and carrier infrastructure, those markets showed more signs of life, continuing their recovery. Enterprise brought in $178 million. Carrier was $138 million. Together, that was up 14% sequentially.
Okay, sequential recovery there. That's good to see.
Yeah, management seemed encouraged by that ongoing trend.
What about the more consumer-facing or cyclical bits?
Consumer revenue was $63 million, which was actually down 29% sequentially. But they said that was mostly expected seasonality plus softer gaming demand after the holidays.
Okay. And auto industrial.
That segment was $76 million, down 12% sequentially. Interesting mix there. Automotive actually grew a bit quarter over quarter, but industrial was lumpy and pulled the segment down.
So the overall picture is crystal clear. Data center, driven by AI and custom silicon, is absolutely powering the train. Enterprise and carrier are recovering steadily.
That sums it up perfectly. And management really leaned into that AI narrative. They see it as the fastest growth driver, and like we said, potentially becoming the majority of the whole company over time. They're even holding a special investor day on June 17th just focused on custom AI.
Right, to give more detail on their strategy, pipeline, market share goals.
Exactly. It underscores how central they view this opportunity.
Okay, let's shift gears to the rest of the financials and the guidance. Beyond the top line and EPS, gross margins.
For Q1, GAAP gross margin was 50.3%, non-GAAP was 59.8%. Operating expenses came in a bit below guidance on a non-GAAP basis, $486 million.
Resulting in operating margin of
14.3% GAAP and a pretty healthy 34.2% non-GAAP.
We talked about the operating leverage driving that big EPS jump. Does the gross margin tell a story too, especially with the rise of custom silicon?
It does. It's an important point they made. The custom business, while it's growing fast and strategically vital, tends to have a lower gross margin percentage than their standard products.
Oh, okay.
So as custom becomes a bigger chunk of the revenue mix, it can slightly weigh down the overall company gross margin percentage, even while total gross profit dollars and operating profit are growing strongly. It's just a mix effect.
Got it. A mix shift dynamic. How about cash flow and the balance sheet?
Cash from operations was strong, $333 million in Q1. Inventory ticked up a bit, $42 million increased to $1.07 billion, which they said was needed to support growth.
And capital returns.
Paid out $52 million in dividends, plus that $340 million buyback we mentioned. Debt is $4.2 billion total, but because EBITDA is growing so fast, their leverage ratios are actually improving. Ended the quarter with $886 million in cash.
Seems like a solid position. Now, the crucial part, the outlook. What did they guide for Q2?
Okay, for the second quarter, they're targeting revenue around $2 billion plus or minus 5%.
$2 billion. That midpoint would be another record high.
Yes, another record. And that $2 billion midpoint represents roughly 57% year-over-year growth. So they expect the strong momentum to absolutely continue.
How does that break down by market in Q2?
Data center, they expect it to grow again sequentially, mid-single-digit percentage range, maintaining that strong year-over-year growth. Enterprise networking and carrier infrastructure combined are also guided to grow sequentially in the mid-single digits.
That'd be the fifth straight quarter of growth for those two combined.
That's what they highlighted, yeah. Suggests that recovery is really taking hold.
And the other markets?
Consumer is expected to bounce back pretty sharply, up around 50% sequentially, driven by seasonality and gaming. Auto and industrial, they expect to be roughly flat compared to Q1.
Okay. And the margins and EPS guidance for Q2?
Non-GAAP gross margin guided between 59% and 60%. Non-GAAP operating expenses around $495 million. Other income about $49 million. Non-GAAP tax rate 10%.
Leads to EPS guidance of?
Non-GAAP EPS guidance is $0.62 to $0.72. The GAAP range is $0.16 to $0.26.
That non-GAAP midpoint, $0.67, is another nice step up from Q1 $0.46. More leverage. Do they give any sense for the second half of the fiscal year?
They were generally positive while still acknowledging, the broader macro uncertainties out there, but they expect AI demand to stay strong and the enterprise carrier recovery to continue. Their view seems to be growth across the board through the rest of the year, setting them up well for fiscal 27.
All right, let's quickly touch on the Q&A. Analysts always dig in. There was some noise about supply chains, particularly around the custom AI stuff. How did Marvell respond?
Yeah, they tackled that directly. Basically said, look, those external supply chain reports often have an incomplete picture, especially regarding confidential programs. They run a tight ship, don't share that stuff.
So they push back.
Strongly. They reiterated the facts. They are the incumbent on the current big XPU program. The ramp was fast and successful. For the next gen, they are engaged. They have secured 3nm capacity for 2026. They sounded very confident they'll grow revenue with this customer for years, regardless of other partners the customer might use.
Message received. Our position is solid. Did they talk about capacity for more customers beyond the big ones?
They did. Said they've boosted R&D, shifted resources to handle more custom engagements. And interestingly, they mentioned a next wave of hyperscalers they're now working with on custom designs.
Next wave, okay. That points to future growth potential.
Yep.
What about Surge's Techs? Any questions there?
Yep. They were asked about their leadership position. They just reiterated their view. Best-in-class performance, fast time to market, pointing to their 200G lead and the 400G demo as proof.
And the NVIDIA NVLink partnership came up again.
It did. They framed it again as validation for custom silicon's role. It lets customers building their own chips leverage NVIDIA's interconnect fabric via a chiplet. Said customers are interested.
Someone asked for more color on the data center growth split, right?
Yeah.
AI versus traditional on-prem.
Yeah. Management said the traditional on-prem piece is smaller, stable, not really a drag, but the overwhelming growth, the 76% year-over-year number, that's all driven by AI infrastructure demand.
And the optical business specifically. How's that doing?
They said it's doing well, expected to grow all year, helped by custom programs needing optics plus general demand. AECs, ramping switching growing. They feel good about their 800 gig share and being first with 1.6 terabit at 5 millimeters and 3 nanometers. They see LPO adoption as sort of incremental, mostly for scale up, and they have solutions ready.
Okay. Last point.
Yeah.
Inventory. Always a concern. What was the tone there?
Sounded pretty comfortable. Said customer inventory seems low. Sell-through was strong last quarter. They expect continued strong growth in optics, especially looking ahead to the 1.6T transition next year.
All right, let's wrap this deep dive. So Marvell delivered a strong Q1 beat guidance, driven by record data center revenue, which itself is overwhelmingly powered by AI, especially custom silicon ramps.
Yep, and they secured the next-gen custom business, highlighting multi-year visibility there, while also building out the platform tech, like co-packaged optics needed for future scale.
Plus, signs of life in enterprise and carrier. A strategic sale, boosting the balance sheet, solid cash flow, more buybacks, and guidance for another record quarter in Q2.
The message seemed to be, we're executing well in AI, the custom strategy is working and expanding, and our core markets are recovering, setting us up for continued growth despite any macro noise. They really wanted to emphasize their tech leadership and the long-term nature of these AI engagements.
So this gives you a really solid grasp of Marvell's current momentum and strategic direction, especially how central they are to this huge AI infrastructure build-out through both custom chips and the advanced connections they require.
It definitely paints a picture of a company firing on, well, several critical cylinders right now.
Absolutely. So here's something for you to chew on after listening to all this. With custom silicon becoming so important and technologies like co-packaged optics demanding such tight integration, what does this really mean for the semiconductor industry long term?
Yeah, like, do chip companies basically need to become partners, almost extensions of their biggest customers' own engineering teams?
Right. And how does a company like Marvell, which does both deep custom work and sells standard parts like interconnects, navigate that? If the biggest customers keep wanting more tailored, integrated solutions, what happens to the traditional way of selling standard chips off the shelf?
Those are big questions. Marvell's results definitely suggest that being able to do both, the custom and the standard foundational pieces, is a pretty powerful position to be in right now.
It certainly seems that way. A very dynamic space to watch.
Okay, that wraps up our deep dive for today. Hope this gave you the quick insights you needed.
Thanks for tuning in.
Until next time.